Hi, I'm Mary Kopczynski, the CEO of Regalytics, with your update on this week's 5,710 regulatory alerts. The regulator of the week is the Louisiana Department of Treasury for a very public open letter to the S&P complaining about ESG metrics being a part of the S&P rating of states, which leads nicely into our topic of the week, ESG. I don't even know how I did it, but somehow I failed to film one of the hottest pieces of news. I mean, I wrote it, I was going to say it, but I just skipped it somehow. But it was the first SEC enforcement action against an investment advisor for misstatements and omissions concerning ESG products. Bank of New York Mellon investment advisor agreed to pay a $1.5 million penalty because they claimed the funds had undergone an ESG quality review, even though that wasn't always the case. On the heels of that, and apparently a coincidence, I understand from the industry, but the SEC proposed a new rule for disclosures for all investment advisors related to their ESG disclosures. The idea is to avoid greenwashing, where advisors are claiming they have an ESG product but don't really have one, or worse, don't even really know if they have one. This week, the SEC also charged Trade Zero America and its co-founders with deceiving customers about meme stock and trading halts. The company falsely stated to its customers that it didn't do trading halts on these suddenly ironic and popular stocks, when in fact it did. In other news, the White House, seeing the lack of speed in our Congress in relation to gun control, went ahead and issued an executive order on the topic. Also, the FTC launched an inquiry into the infant formula crisis. The FTC also fined Twitter $150 million this week because even though it's not Twitter's first rodeo or run-in with the FTC on data privacy issues, Twitter still managed to promise users that they would only use data about the users to secure their account, but instead used it to target their customers for financial gain. Moving on, the CFPB is opening a new Office of Competition and Innovation. Additionally, the CFPB confirmed this week that an already existing federal anti-discrimination law requires companies who reject someone's credit application to explain the specific reason that they were denied. The Office of Science and Technology Policy and the National Science Foundation are seeking comment on the initial findings and recommendations contained in the interim report of the National Artificial Intelligence Resource Task Force. Turn your comments in at the end of this month. The California Department of Financial Protection and Innovation put out a completely confusing statement about whether cryptocurrencies are a viable form of money or speculative non-money asset. They also helpfully stated that they had not yet concluded whether the types of decentralized virtual currencies held and traded by companies are actually a form of money. Likewise, the department has not determined whether wallet and exchange services are required to register under California's Money Transmission Act. Thanks, California. Speaking of the unknown, the European Central Bank put out analysis on the impact of Russia's invasion of Ukraine on the economy, stating that it still doesn't know the longer-term impact. But what has been a problem is the prices for commodities and energy, which are elevated and volatile, and are causing stress in the derivatives markets for these products. And speaking of derivatives, the CFTC settled this week with a large energy and commodities trading firm for manipulative and deceptive conduct. Glencore is required to pay a total of $1.18 billion, which consists of the highest civil monetary penalty and the highest disgorgement amount in any CFTC case in the history of the CFTC. So that's it this week for Regalytics. We have the most comprehensive, coherent, and customizable regulatory alerts tool in the world. Come and see how company after company is transforming their compliance with this kind of transparency. See you next Wednesday.